Welcome to the Deep Dives. Today, we're taking a massive detour from the usual headlines and plunging right into the structural foundation of personal finance. We're talking about the professional planning process.
Right.
It's something that, affects every single person, yet it's so often seen through this fog of just transactional salesmanship.
It is complex, and frankly, the industry has historically made it that way, a bit opaque. Our sources for today, they read almost like an internal professional standards guide. They really lay bare the kind of mandated rigor and the ethical expectations that are required of a modern financial advisor.
So if you've ever wondered what real financial advising looks like, beyond just being sold an investment product, this is the deep dive for you.
Jackal.
Our mission here is to take you behind the curtain. We want to distill the structure, the ethics, and frankly, the sheer effort that's required to create genuinely effective, personalized financial advice.
The idea is for you to understand the blueprint.
Yeah, so you can demand that highest level of service and know exactly what questions you need to be asking your advisor.
And at the very heart of this entire discussion is I'd say a profound structural shift. The central tension, the change that has really remade the industry, is this forced migration from being product-driven to being client-driven. And this isn't just cosmetic, it's a necessary evolution driven by market maturity, by technology, and, of course, intense regulatory pressure. The old model is just demonstrably failing clients.
That's the perfect hook. Okay, let's unpack this. Let's start with why the old way, that sales-first approach, just doesn't work anymore in the modern financial world.
Okay.
So this dying model, this product-driven thing, it was, I guess, very simple from the company's perspective, right?
Oh, incredibly simple. The advisor's main objective was volume. It was all about volume. They focused singularly on selling specific products, usually the ones their own institution created.
So every client meeting was really just judged on
the immediate revenue.
Yeah, the money they made from that one single transaction.
Exactly. The goal was hitting sales quotas, maximizing the value of that one sale, and really little else.
So you might walk in asking about, say, retirement, but you'd walk away having been sold an indexed annuity that just happened to net the highest commission that quarter.
That's the classic scenario. There was zero emphasis on relationship building or, any kind of long-term strategy.
And that's that reactive model you mentioned, only doing what the client explicitly asks for.
Which is so inherently limited. The client often doesn't know what they truly need. If they walk in and say, I need to open an investment account, the reactive advisor just sells them an account.
End of story.
End of story. The new standard, the client-driven role, is based on a relationship of trust where the advisor has to uncover the client's underlying needs, often needs they didn't even know they had.
So financial advising is no longer a transaction. It's a methodology. Our sources define it as this systematic method used to assess a client's really complex situation, to clearly define and prioritize their goals, and then, and only then, develop these integrated strategies to meet them.
Which requires the advisor to be entirely proactive.
And what does being proactive really mean in this context?
It means stepping way outside the box of just being an order taker. The advisor is actively assisting clients in defining their needs, assessing whether various solutions are even appropriate, and, integrating every single part of their financial life.
So they're not just selling a product.
No, they are selling a tailored, ongoing strategy.
And crucially, that strategy has to be grounded in reality, right? Which means a really in-depth look at lifestyle constraints and goals. This is where the counseling part of the job comes in.
Absolutely. When we talk about lifestyle, we're talking about the tangible way people spend money.
The car, the house.
Exactly. The size of the mortgage, how often they travel, luxury purchases, all those general spending habits. The advisor must operate within the client's actual financial capacity.
That's the reality check.
It is. And if a client's stated goals, like, say, retiring early, totally clash with their spending habits, maybe they have huge fixed expenses, well, the advisor has a very difficult job ahead of them.
And our professional guide notes something very specific here. It says, if the client is visibly living beyond their means, if they've taken on what it calls excessive personal debt, the advisor's first mandatory role is to prioritize getting rid of that debt above almost all other investment goals.
That's right. You simply cannot build a sustainable financial strategy on a foundation of crumbling debt. It just doesn't work.
It's the advisor's job to be that objective voice in the room.
To be the one who asks, okay, which of your dreams, early retirement, the education fund, a bigger house, which of these are genuinely realistic? Which are most important right now, and what precise, maybe difficult steps do we need to take to get there?
And that's what separates the professional partner from just a yes man salesperson.
100%.
Okay, so that establishes the what, but let's dig into the why. What specifically forced this huge change in the industry? Our sources point to three big drivers. Let's start with regulations.
Regulations were a massive, massive catalyst. I mean, historically, the financial industry operated in silos, right? Banks handled deposits, insurance agents sold policies, brokers managed stocks. They didn't really talk to each other.
Everyone in their own lane.
Exactly. Regulatory shifts pushed the whole system toward an integrated financial services market. So institutions were now allowed, and in some ways required, to offer a whole suite of services under one roof.
And what did that integration mean for the advisor on the ground?
It raises the professional bar significantly. I mean, if you're now offering a complete package, banking, insurance, investing, mortgages, you need advisors who are competent across that whole spectrum, not just specialists in one little product.
So that leads to stricter licensing.
Stricter licensing, higher compliance costs for the firms, and intense scrutiny on how that integrated advice is delivered objectively. The client now expects a single, comprehensive solution, and the advisor has to deliver that.
Okay, driver number two was technology. We touched on ATMs and online banking, but what was the deeper impact of that digitalization on the advisor's actual job?
Well, digitalization didn't just automate deposits, it commoditized simple information and transactions. A client can now open a basic trading account on their phone in minutes.
Right.
They don't need an advisor for execution anymore. They need them for analysis, for strategy, for risk mitigation.
So when a client walks into an advisor's office today,
They aren't coming with a simple request. They're coming with complex questions and needs that technology can't solve. Things like coordinating estate planning across multiple jurisdictions, or navigating complex tax rules for a small business, or understanding something like sequence of returns risk in retirement.
so the advisor's role shifted from being a transaction processor to a highly skilled consultant.
Yeah.
That's a fundamentally different job.
It is a fundamentally different job, requiring a fundamentally different skill set.
And the third factor you mentioned, product proliferation, that just amplifies this complexity.
Oh, it really does. I mean, think about the landscape 60 years ago. A typical bank offered maybe a handful of products, a checking account, a savings account.
Simple and straightforward.
Very. Today, the product list within a single large institution can easily top 100 different offerings. You've got various types of mutual funds, different classes of life insurance, complex annuities, specialized accounts like RRSPs or RESPs, specialized debt products.
It's overwhelming.
It's completely overwhelming. For the average client, trying to navigate that maze is impossible, which in turn dramatically increases the need for a professional advisor who can objectively cut through all that noise and match the right product to a specific complex need.
Here's where it gets really interesting. This entire convergence of forces, regulation, technology, and this sheer volume of products. It means the advisor's ultimate function is no longer to sell specific things to hit a quota. It's to provide complete, objective financial information. Their service is the knowledge that allows clients to make genuinely informed decisions that are tailored uniquely to their individual situation.
And this brings us right to the structure of how this is all delivered. The full service offer. This isn't just a marketing term. It's a commitment to considering all aspects of the client's life.
Their income, debt, taxes.
All of it. Their insurance needs, their investment temperament, their estate plans, all to develop one single integrated strategy.
And you mentioned earlier that decreased regulation actually allowed this, which is a huge benefit for the client because instead of going to, three separate specialists?
A banker, an agent, a broker.
Right. And just hoping their advice all lines up, they can now rely on one source to provide that comprehensive, cohesive service.
That cohesive service is the key. It's what minimizes strategic conflicts. And for the advisor, this structure prevents them from making a recommendation in one area, say investing, that accidentally sabotages another area, like the client's liquidity or their tax burden.
So let's look at the practical application. Our guide details a pretty clear 5-step process for delivering this full-service advice. Let's map out what's required at each stage.
Okay, so step one, assess the client's financial situation. This is about getting the lay of the land. You're trying to determine their overall financial flexibility and their robustness. It's an exhaustive data collection exercise.
So you're gathering the hard financial info.
Yeah.
Income, expenses, assets, liabilities.
Right, but you also have to gather critical personal information.
And that goes beyond just the dollars and cents. What does that personal info entail?
It's about their work situation, any legal arrangements they have, like prenups or shareholder contracts. It's about their health status and, critically, any dependents or financial partners involved.
Because those people in agreements represent both dependencies and liabilities.
Exactly. This initial assessment has to be holistic.
Okay, step two. Define and prioritize goals. This sounds like the art of listening.
It is. The advisor has to encourage the client to just talk freely about their dreams, but then they have to probe. It's not enough for a client to say, I want a house.
You need details.
You need details. By when? How much will it cost? What other goals are you willing to sacrifice to get it? This is what defines the hierarchy of importance and establishes clear timelines.
First leads right into step three, the necessary moment of truth.
Adjust the strategy based on financial capacity. Once the goals are defined, the advisor does the crucial calculation. What are the concrete financial implications? If the client wants to retire in 10 years with, say, $100,000 a year in income, the advisor has to calculate the exact portfolio size and the required savings rate to get there.
And then they compare that required rate against the client's current reality.
Yes. Can the client actually withstand the impact of that savings rate? Will it require significant, maybe even painful, lifestyle changes?
And if the math doesn't work?
If the math doesn't work, the advisor's duty is to counsel them to adjust the strategy. It's the advisor's job to show them the numbers that necessitate that change.
Okay, so once the strategy is feasible, then step four is to identify financial product and service options.
And notice, only after the strategy is adjusted and confirmed as feasible do we even start looking at products.
All right.
And the key mandate here is that the options have to correspond specifically to the client's needs, never to the advisor's sales quotas. The goal is information disclosure, allowing the client to make the final informed decision.
And finally, step five, conduct a periodic review. This isn't a one-and-done thing.
No, the planning process never ends. Circumstances change. The client's situation has to be reviewed at least annually. The advisor has to rigorously measure progress against the original milestones and identify any gaps or discrepancies.
And if the client is off track, the advisor has to figure out why.
Exactly. Was the original goal too ambitious? Was there an unexpected expense? Or, did the advisor fail to correctly assess the client's motivation or their spending habits in the first place? The review is a feedback loop that continually refines the strategy.
Let's make this concrete with a real-world scenario from the guide. Let's talk about Max and Sonia Breton.
Okay, Max and Sonia are a young couple. They're living in a condo downtown, and Sonia is pregnant with their first child.
So their primary overwhelming goal is stability.
Right. They want to buy a bigger, family-friendly house in the suburbs, and they want to do it within 2 years.
But Max has another immediate and pretty important lifestyle goal. He desperately wants to take this big, expensive trip to Italy before the baby arrives.
Knowing that this kind of travel will be basically impossible for years afterward.
So their advisor, Brian, he moves directly to steps 2 and 3, prioritization and adjustment.
He does. He initiates that counseling process. He asks the defining question. Max, what is more important right now? The emotional satisfaction of the trip to Italy, or the financial stability and the required down payment for the family home?
But the numbers don't lie, do they?
The numbers are relentless. Brian points out that taking the trip would significantly deplete their savings, pushing that down payment target further and further out. And on top of that, they're about to incur all the unavoidable costs that come with a baby.
Cribs, clothes, maybe lost income.
Right. Every single dollar spent on that trip comes directly out of their future down payment.
And Max agrees the house has to come first.
The trip is sacrificed. Brian then defines the specific, measurable goal, save 10% of their combined income every single month. He identifies specific savings vehicles for them. And he calculates that if they stick rigidly to this plan, they can realistically afford the house in 18 months.
Which is a specific timeline. It makes the sacrifice feel worthwhile.
Exactly. And this is a perfect illustration of the advisor's core non-investment skill, which is counseling. They aren't just looking at the math, they're managing the human element and ensuring that essential lifestyle goals are prioritized over impulsive or short-term desires.
It requires some hard conversations.
It does, but those conversations are the true value of the advising relationship.
Okay, so that five-step overview gives us the practical flow. But for professional documentation, for compliance, the industry relies on the formal six-step financial planning process.
This is the backbone of rigor. And it doesn't matter if the client is proactive or only comes in after a financial crisis, the process is the same.
And the fundamental principle remains. The final plan has to be completely unique and specific to that individual.
It must be efficient. So, achieving the best results with minimal wasted capital and, most importantly, effective, ensuring the stated objectives are genuinely met.
So let's start with step one. Establish the client-advisor relationship. This isn't just a handshake, is it?
No, not at all. It's a detailed, preliminary process designed to manage expectations and make sure both parties understand the boundaries of the relationship right from the start,
It begins with the initial interview.
which needs to be a detailed scoping exercise. The advisor determines the client's perceived issues, thoroughly explains the entire planning process they're going to use, discusses potential alternatives, and identifies any specialist expertise that might be needed down the road.
And, critically, provides a clear, upfront disclosure of possible conflicts of interest.
That disclosure is absolutely mandatory under the new client-driven model. It signals that the advisor recognizes the inherent conflict of, working for an institution that sells products while also needing to recommend the best solution, even if it's external.
It's an immediate demonstration of objectivity.
Exactly.
So if the interview goes well, the relationship is then formalized, usually with a letter of engagement or a professional service contract.
And this contract has to be exhaustively clued to prevent any future disputes. It must unambiguously outline the specific information the client needs to provide, the exact services the advisor will deliver.
And how they're getting paid.
Yes. How the advisor will be compensated, fee only, commission, a mix, how any third-party professionals will be paid, and the expected duration of the relationship. Clarity and transparency are non-negotiable legal and ethical requirements.
And this leads us directly to the responsibilities and ethics that underpin this entire thing. The client is sharing their most sensitive information. Trust has to be earned.
It does. The advisor has to disclose their qualifications, experience, fees, the whole structure. But let's go deeper into the 5 core ethical duties that our guide outlines. These are really the pillars of the whole approach.
Okay, what's first?
First, integrity. Be honest and upright. Simple, but foundational. This means never misrepresenting performance, risk, or fees.
Second, professionalism. Be competent and knowledgeable.
And this isn't static. It means constantly updating your knowledge on regulations, new products, economic conditions. And if you don't know the answer, you refer the client to someone who does.
Third, confidentiality. This seems huge.
It's vital, especially when you're handling highly sensitive records like tax returns, medical information for insurance, or, details of a separation agreement. The client must be reassured that their privacy is strictly protected.
Fourth is objectivity. This one seems like it would be the most challenging in practice.
It arguably is. It means the advisor must make recommendations that solely benefit the client, even if that means advising them to choose a superior product or service that's not offered by the advisor's own institution.
That's the direct countermeasure to the old sales model.
It is. And fifth is diligence. Investigate all recommended products thoroughly. If the advisor refers the client to another specialist, like a lawyer, they have a duty to supervise that interaction closely to make sure the client's overall plan stays cohesive and on track. It's active oversight.
Okay, let's move to step 2. Collect data and information. This is where the emotional and technical rubber really hits the road. The advisor is asking some deeply personal questions here.
They are, and they absolutely must communicate empathy and professionalism. The advisor needs to acknowledge the vulnerability that's involved in sharing this kind of data. They have to explain why every piece of information is essential and provide ironclad reassurance of strict confidentiality.
And the data falls into 2 critical, he said often contradictory, categories. Let's start with the easy one, quantitative data.
Quantitative data is the hard evidence. It's the numbers on the paper. We need all records related to their personal finances. Income and expense statements, detailed asset lists, liability lists, tax returns, insurance policies, any relevant legal documents.
And for business owners.
If they own a business, we need financial statements, shareholder agreements, employee benefit details. This is the explicit, measurable side of the ledger.
Then we have the other type, the more elusive one, qualitative data. This is gathered through skilled interviews and observation.
This is where a good advisor really earns their fee. Qualitative data assesses the client's temperament, their emotional drivers, their fundamental understanding of economic concepts. It helps determine their true tolerance for risk.
And you mentioned this is often implicit data. It's what the advisor infers from behavior, not just what's said.
Exactly. And crucially, this data identifies potential conflicts between what the client says their goals are and their underlying attitude.
Can you give us a concrete example of that kind of conflict?
Of course, a client might state in the interview, I want maximum growth, I'm aggressive, I can handle volatility. That's explicit.
Okay.
But then the market drops 10%, and that same client is calling every day, panicking, demanding to sell everything. That panic is the implicit data. Their true risk tolerance is actually quite low.
And the advisor who only relies on the explicit statement is in trouble.
They'll build a portfolio that the client will abandon at the worst possible moment.
That's a huge insight. So the goal of all this data collection is to define and prioritize goals properly. And our sources define 4 specific characteristics that effective financial goals must have.
First, they have to be specific and measurable. This is the difference between success and failure. A client saying they want to be financially comfortable in retirement is useless.
It has to be a number.
It has to be a specific dollar amount. For example, $85,000 net income per year, adjusted for 3% inflation. That specificity lets you monitor performance.
Second, they must be ordered in level of importance.
Right. Resources are finite, so choices have to be made. Should you prioritize the kid's education fund or paying down the mortgage? The advisor forces this prioritization.
Third, they must be defined by time frame.
This creates actionable milestones. Saving $200 a month for 5 years for a new car is a clear short-term goal. Saving $5,000 a year for 18 years for a college fund is a long-term goal. The timeline dictates everything.
And fourth, they must be acceptable in level of risk.
This links directly back to that qualitative data. If the client's implicit risk tolerance is low, the asset allocation has to be conservative. More fixed income, more money markets, even if that means a lower potential return. The client has to be comfortable with the plan's volatility.
Let's bring in our key running case study here. Albert Roscoe, he's 41, a senior project manager, and he calls his advisor, Brian, for help with retirement savings.
So Brian immediately uses that specific and measurable characteristic. Albert vaguely says he wants enough to be comfortable.
But Brian pushes him.
He does. He says, Albert, what does comfortable look like in today's dollars? How much cash flow do you need every month when you stop working? He gets a concrete target figure.
And more critically, during that qualitative interview, Brian notices the conflict.
He does. Albert explicitly states he wants to aggressively pursue equity mutual funds, hoping for spectacular growth. But when Brian describes typical market volatility, the deep dips, Albert expresses genuine anxiety and hesitation.
So that's the discrepancy.
That is the crucial discrepancy. Albert's stated desire completely conflicts with his actual implicit risk tolerance. And it is the advisor's responsibility to document both the desire and the anxiety, because that conflict has to be resolved before any recommendation can be made. It just shows the rigor of step 2. You need the documents, but you also need to understand the human being. So once step 2 is complete, we transition to the technical heavy lifting. Step 3, analyze data and information. This is where the advisor takes that huge pile of quantitative and qualitative data and uses sophisticated modeling to answer the core question.
Are my clients' goals even feasible?
Exactly. Are they feasible given their current reality? This analysis identifies their immediate strengths and weaknesses by projecting their current position forward. It's comparing today's actual net worth against tomorrow's required portfolio size.
And the analysis areas are broad, right? Tailored to the client.
They have to be. For someone like Albert, it means a debt management review, tax optimization potential, a detailed risk analysis, like what happens if he gets laid off. And of course, a retirement needs analysis. The advisor has to generate specific financial statements here. Net worth, income and expense, and those crucial retirement models that factor in inflation.
So what are the specific duties of the advisor during this analysis? First, they have to identify existing gaps.
Gaps are the immediate shortfalls. For example, a high debt burden relative to income, a complete lack of portfolio diversification, or dangerously inadequate insurance coverage. These are problems that exist right now.
And second, identifying potential problems.
These are issues that haven't happened yet but are highly likely to derail the plan. This is where the professional knowledge comes in, pointing out the absence of a critical emergency fund or the failure to account for rising healthcare costs in retirement projections.
And third, the advisor has to incorporate current and forecasted economic conditions.
hmm They have to model the plan against expected inflation rates, anticipated interest rate movements, and long-term market return averages. They have to communicate to the client that the plan is not a static calculation, but a dynamic projection that's sensitive to all these external forces.
This analysis sounds like where a lot of optimistic dreams might die a quiet death.
It's where they meet reality.
Hmm.
And if the goal is not feasible, the advisor is ethically bound to present that data and counsel the client to accept more realistic objectives. It's a massive part of their job.
It's a counseling skill.
It absolutely is. And they have to provide actionable modifications. If the client can't retire at 56, the alternatives have to be clear. Increase the time horizon, reduce the desired retirement income, increase the acceptable level of risk if they can handle it, or drastically cut expenses. You're providing a menu of difficult choices, not just a vague rejection.
So let's apply this to Albert Roscoe's case. Brian conducts the analysis.
Right. Albert's goal is to retire at 56, which is 15 years away.
His strengths are no debt, he's got $75,000 in an RRSP, and a defined pension plan.
But the weaknesses and constraints are significant. He has very high expenses, only minor insurance coverage, and critically, almost no liquid savings outside that RRSP. A massive gap where an emergency fund should be.
And then there's that qualitative conflict.
He wants high returns while insisting the investment be safe, which Brian confirms is just an unrealistic expectation in the current economic climate without taking on significant risk that Albert is clearly uncomfortable with.
So Brian's calculations reveal the harsh truth.
They do. To retire in 15 years and maintain his current high expense level, Albert would need to save an astronomical amount, far more than his current income allows, even with his pension.
And Albert is dismayed. This is the crisis point.
It is. And Brian intervenes with that counseling skill. He proposes a revised plan. The modification has two steps. First, retire 5 years later at 61, and second, reduce the projected post-retirement income requirement by 15%.
And he shows Albert this specific math.
Yes, demonstrating that this revised plan is challenging, but it's achievable. And Albert agrees to the revised targets.
So feasibility is established. We can move to step 4. Recommend strategies to meet goals. Now that they know what can be achieved, the client asks, okay, how do I actually do it?
And the recommendations have to be intensely personal. They are tailored not just to the revised financial goals, but to Albert's values, his lifestyle temperament, and his now explicitly quantified low-risk tolerance. The plan has to align with the person, not just the math.
And the guide stresses that this recommendation process is a two-way street.
Definitely. The advisor proposes the solution, but the client has to ultimately sign off. This requires a defined back and forth. Discuss the proposed strategies, field the client's questions and concerns, modify or revise based on feedback, and only then finalize the new recommendations.
And the guidelines here are very strict. Recommendations must be specific, not general.
The difference between start saving for retirement and establish an automated monthly contribution of $500 into the equity mutual fund portfolio held in your RRSP is the difference between a nice idea and an actionable step.
And the advisor has to provide full, true, and plain disclosure.
Which means outlining all the associated fees, the service level, how often they'll get reports, and most importantly, the risks associated with the recommendation. And all recommendations must be provided in writing.
What if the client needs specialized help?
Then the advisor has a duty to refer the client to qualified specialists like lawyers or chartered professional accountants. That fulfills their diligence and professionalism duties.
So let's see Brian's recommendations for Albert. He had 2 core areas of concern: liquidity and retirement funding.
Brian recommends prioritizing the emergency fund first. He suggests Albert build up 3 to 6 months of living expenses in a liquid, high-interest savings vehicle before maximizing RRSP contributions. This addresses the significant potential problem Brian identified in step 3.
And secondly, he suggests specific savings targets.
Right. A $500 monthly RRSP contribution, or finding ways to reduce discretionary expenses, eating out less, downsizing his apartment to accelerate savings, and maybe retire earlier than 61.
And Albert's response again highlights that two-way street. He pushes back.
He does. He pushes back on the emergency fund priority, citing high job security and excellent workplace insurance. He says he prefers to immediately maximize retirement savings and is willing to accept the risk of lower liquidity.
So Brian accepts the client's final decision. But he doesn't just walk away.
No. Because Albert remains so conflicted about risk wanting high returns but hating volatility, Brian addresses this by referring Albert to a specialized financial planner, Gloria Velasquez.
And this is a textbook example of objectivity.
It is. Brian recognizes that Gloria has access to a wider universe of investment products and deeper expertise in specialized portfolio management that can try to reconcile Albert's conflicting desires more effectively than Brian can within his institutional scope. The referral is made purely in Albert's best interest.
Okay, so we've moved from diagnosis and strategy to action. We're at step 5. Implement recommendations. This is about execution, guided by the timeframes established way back in step 2.
Right. Implementation is about converting the plan into concrete measures. This might be immediate, like, applying for new term life insurance or setting up a debt consolidation loan.
Or it could be long-term.
Or it could be long term, like establishing those automated periodic investment contributions for the RRSP. The advisor guides the client through all the necessary paperwork and logistics.
And since Brian had to refer Albert to a specialist, Gloria Velasquez, the advisor has to follow a very strictly defined procedure for referring clients to a business partner. It's very structured.
And that structure is designed to minimize risk and ensure continuity for the client. First, you identify the specific technical need, which for Albert was complex portfolio management. Second, identify the specific partner, Gloria Velasquez. Third, get Albert's explicit agreement to the referral. Fourth, confirm Gloria's availability and her specific expertise. Fifth, arrange the meeting, which could be a joint meeting or a separate one.
And sixth, and this seems like where diligence really matters, you have to follow up.
You have to follow up with both the client and the partner to make sure the connection was made, the meeting happened, and the client's needs were successfully addressed. The advisor remains responsible for the overall success of the plan, even when they outsource parts of the execution.
So in Albert's case, Brian immediately sets up the $500 monthly contribution and the automated deductions. That's the low-hanging fruit.
Right. And at the same time, he makes the formal referral to Gloria, reinforcing to Albert that this specialization is essential because of his conflicting risk tolerance. Brian then follows up to ensure Albert actually met with Gloria and the specific investment products were implemented.
This subjective referral really highlights the monumental difference between the old and the new models.
It really does.
The new advisor knows that if a partner can offer a better solution, the ethical duty is to send the client there, even if it means sacrificing some internal revenue.
That is the ethical mandate of objectivity in practice, which brings us to the final and really the perpetual step. Step 6. Conduct a periodic review or follow-up. This is the long game.
And why is this review so essential? I mean, things change, right?
Circumstances always change, personal lives shift, and the economy certainly never stands still.
So an annual review is the baseline.
An annual review is generally the baseline requirement just to measure progress. But any significant life event demands an immediate review. A major life change, a birth, a death in the family, a divorce, a serious illness, an unexpected inheritance, a job loss.
With those.
Any of those must trigger an instant reassessment because they fundamentally alter the client's priorities, their liquidity needs, and their risk exposure.
And external economic shifts also require this diligence.
Oh yeah. For instance, if interest rates suddenly drop by 2 percentage points, the advisor has to proactively reach out to clients with mortgages to review potential refinancing options. They aren't waiting for the client to ask. They're monitoring the landscape for opportunities or threats.
So the advisor's role in this review is pretty comprehensive.
It is. They monitor progress against the milestones. They adjust the plan based on any changes in the client's lifestyle or even their temperament. They adapt to economic or legislative changes, like new tax rules. And they must objectively introduce new products or services, even if they're external to their own firm.
So let's see this critical adaptation in action. We're closing the loop on Albert Roscoe's journey 1 year later.
Okay. Brian conducts the mandated annual check-in. Albert admits he missed several of the $500 monthly deposits.
Why?
Due to increased unexpected family expenses. This immediately signals a discrepancy. The strategy was just a little too aggressive for his actual capacity.
But then a major external change occurs.
A huge one. Albert reports that significant layoffs have recently hit his company, and his job security is now shaky.
So the long-term retirement goal is instantaneously overridden.
By the immediate need for survival and liquidity, this is a perfect example of a priority shift. The aggressive long-term saving strategy is now actually dangerous. The immediate need is liquidity preservation and financial safety.
So Brian has to adapt the plan instantly and professionally.
He does. He suggests stopping the RRSP contribution immediately and redirecting those funds, plus any extra cash flow, toward building up that liquid emergency fund he had recommended in the first place.
The long-term retirement planning is temporarily suspended?
It's put on hold. The entire focus shifts to short-term liquidity preservation. And this demonstrates the entire structural difference. Financial planning is not a piece of paper you sign and file away. It is a living strategy.
And the advisor's value is in their ability to dynamically meet the client's current situation.
Shifting seamlessly from aggressive retirement planning one year to conservative liquidity preservation the next when a crisis looms. That's the job.
We have successfully navigated the entire rigorous structure of modern financial advising. What seems clear to me is that the shift from product-centric reactive selling to an objective, relationship-based proactive partnership is just. It's monumental, and it's mandatory for any advisor hoping to provide real value today.
The complexity of modern finance requires this rigor. The six-step planning process is a necessary scaffold that ensures comprehensive service, covering everything from detailed data collection to objective implementation and that perpetual review.
And for you, the listener, the key takeaways here are actionable. Effective financial planning hinges on deep data collection, not just the quantitative numbers, but that elusive, crucial qualitative data that assesses your true risk tolerance.
And your goals must be meticulously defined using those four characteristics: specific, measurable, ordered, and acceptable in risk.
Right. Don't accept vague advice.
And remember the ethical mandate. The advisor's commitment to objectivity and diligence, particularly in navigating conflicts of interest and providing specific written recommendations, is the marker of a true professional partner versus a mere salesperson. This whole system is built to protect the client from that product maze.
What's so fascinating here, I think, is that the advisor's most crucial skill is often not complex mathematical modeling, though that is essential. It's the ability to listen deeply, to probe for that implicit emotional data, and to have the necessary counseling skills to help clients reconcile their ambitious dreams with the cold, hard reality of their financial capacity.
It requires emotional intelligence as much as technical knowledge. That ability to foster trust and facilitate difficult choices, that's the new benchmark.
It's all about grounded assessment and prioritizing long-term survival over short-term wishful thinking. So we'll leave you with this final provocative thought. If your current financial strategy was subjected to this rigorous, objective, six-step review today, which of your primary goals, be it a trip to Italy, an expensive hobby, or an early retirement date, would an objective advisor immediately force you to sacrifice or drastically alter based on your current documented financial capacity? Something to mull over as you plan your next move.